Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
Welcome to Business Line's State of Economy podcast. Over the last couple of years, sugar has zigzagged sharply. Supplies from India drying. Globally, raw sugar prices have been ruling over 20 cents a pound over the last few months. Prices are currently ruling around 22 cents on fears of supply from Asia being affected. In particular, Indian supplies have been curbed in view of sugar production being affected by deficient rainfall. Asian supplies have been affected also because of El Nino, and the situation is expected to prolong since the warm weather is expected to end only by June. Risks of supplies due to congestion of Brazilian airports also exists. In this context, how will sugar market be in 2024? To tell us more about the evolving situation, we have with us Matthew Biggin, commodities analyst, BMI, based in London. BMI is a unit of Fitch Solutions. Welcome to Business Line's State of Economy podcast, Matthew. Today, we have a discussion on the sugar market in 2024. Sugar has been one of the most volatile commodities in the recent past, rather agri-commodities. How do you see the sugar market behaving in 2024?
Yeah, thanks for that. So, at the market closed on January the 16th, ICE listed front month sugar futures closed at about 22.5 cents a pound, and that's up almost 2 cents since the start of the year. It's around a 9% increase. However, while sugar has found some upside support over the last couple of weeks, it's important to note that we've seen a sharp decline from the 12-year high of nearly 28 cents in November. While we don't expect international prices to reach the highs of 2023 and 2024, with our forecast currently indicating an average price level of 23.5 cents per pound, we do expect prices to remain considerably elevated compared to historical averages. In fact, our price forecast indicates that we actually expect sugar prices to find some upside support from where they currently stand. So why is that? Well, firstly, I think it's important to give some context and discuss what has caused the sharp decline in prices since the end of November. So for starters, India's made this call to restrict sugarcane juice and syrup use in making ethanol, which is pretty big news. What it does is it keeps more sugarcane for making sugar. So that's taking some of the edge off shortage concerns. And then there's Brazil. Despite all the chatter about the potential logistical challenges, they've gone and set a new record by shipping out 3.7 million tons of sugar in November alone. We put these two big moves together from the top sugar exporting countries, and that's what's really behind the big price drop we've seen since November. But here's the thing, even though Brazilian exports have dampened international prices since November, India's export limits mean that the global market will be particularly dependent on Brazilian exports throughout 2024, causing prices to become even more sensitive to any developments in the world's most important sugar market. And this could trigger bouts of short-term volatility as the market reacts to any murmurs of logistical challenges at Brazil's ports. For sure, Brazil's exports have been smooth sailing so far, as we would largely expect at this time of the year, with congestion at Brazil's ports at its lowest. But there are some challenges ahead. With Brazil set to juggle record exports of not just sugar, but soybeans and well above average levels of corn, there's going to be a lot of competition for export capacity. Sugar shipments are pretty steady throughout the year, but come March, soybean exports shoot up and corn exports pick up by mid-year. This means sugar is going to have to elbow its way through a crowded export scene, especially from March to September, with peak levels of competition occurring around August, which could provide a boost for global sugar prices.
How will be the market balance in 2024? Which are the countries where production could rise this year?
Yeah, thank you. So the global sugar market is set to experience some shifts in the coming seasons. For 2023-24 season, we're actually seeing a slight surplus on the horizon, about 0.5 million tons more sugar than the market needs. This represents a modest increase from last year's surplus of around 0.2 million tons. However, it does suggest that supplies might be tighter than in the past. Now, where is this surplus coming from? So Brazil is leading the charge with a 9% increase in production, and that's certainly helping to offset some of the declines we're seeing elsewhere, most notably in India. These two countries are pivotal in the sugar trade, and together they account for around 42% of global sugar production. Other significant contributors to global sugar production include Thailand, China, the US, and the European Union. While consumption is projected to grow by 2% year on year, it's not expected to keep pace with production. thus contributing to an increase in the surplus. However, as we look ahead to the 24-25 season, there are signs that the market may tighten. India is potentially facing a third year of sharp reductions in output, which will cap global output and contribute to tighter global supplies, potentially swinging the global market into a deficit in 24-25. And while Brazil has been a strong producer and has been able to offset the decline in India during the 23-24 season, it's unlikely that we'll see the same level of growth in Brazilian output during the 24-25 season that we've seen in the 23-24 season. Additionally, expectations of a third successive decline in India's output reduce the likelihood of any easing of India's export restrictions, capping the world's exportable volumes. And the possibility of continued export restrictions from India, coupled with the unlikely replication of Brazil's substantial growth in output for the 24-25 season, suggests that global supplies could tighten further. As a result, the global market will rely heavily on Brazil's production, which may not be able to sustain the same growth levels. So in conclusion, while the 23-24 season appears balanced with a slight surplus due to strong production from Brazil, the potential for a deficit looms in the 24-25 season. The market stability will largely depend on these two countries, with Brazil poised to maintain its position as the world's largest sugar producer, and India's policies and production levels as key factors influencing the global supply and global exportable volumes.
Thanks, Matthew. What has been the impact of El Nino on sugarcane? Will India's production continue to be affected by El Nino?
Yeah, of course. So El Nino's influence on sugarcane has been particularly pronounced in India, a country where agriculture forms the backbone of the rural economy, and it's deeply interwoven with the monsoon season. So the phenomenon, characterized by warmer ocean temperatures in the central and eastern Pacific, alters weather patterns globally and typically results in drier, warmer conditions in regions like South Asia. This shift can significantly stress sugarcane, a crop that thrives on ample water, potentially leading to diminished yields and production deficits. In India, sugarcane is extensively cultivated in areas where the monsoon is integral to the irrigation cycle. When El Nino curtails these rains, Indian farmers often face a tough choice: continue with water-guzzling sugarcane or switch to more drought-resistant crops. This strategic pivot, while critical for short-term agricultural viability, has wider repercussions for India's sugarcane output and the international sugar market landscape. So the pervasive concerns about El Nino have significantly influenced global sugar prices, driving them to multi-year highs in 2023. The repercussions have been acutely felt in India and Thailand, where sugarcane crops suffered due to the aridity. In India, the resultant low reservoir levels in key sugar-producing states have led to the recalibration of crop choices, with farmers opting for less water-reliant varieties. So looking ahead, the US Climate Prediction Center's projections suggest a waning El Nino, transitioning to a neutral climate by April to June of this year. This forecast bodes well for India's sugar sector and broader agricultural interests. However, it's important to note that while the easing of El Nino is encouraging, the benefits might not fully materialize until the 25-26 season. We're forecasting a significant rebound in domestic production by then, following 3 consecutive years of diminishing yields. For the upcoming 24-25 season, the planting, which commenced in late September to October 2023, was already impacted by suboptimal conditions due to an unusually dry August. This means that the detrimental effects of El Nino have already negatively affected the 24-25 crop. So despite this, the prospect of an easing El Nino offers a silver lining. As conditions gradually improve, we can expect the negative impact on sugarcane output to be reduced. In conclusion, while India's 24-25 sugarcane production may have been compromised, there's cautious optimism that an easing of El Nino will offer some reprieve and set the stage for a more robust recovery in the subsequent season.
How do you see the ethanol factor playing out this year, and how much of sugarcane will be diverted for ethanol in Brazil?
Yeah, of course. So ethanol production continues to be an influential factor in the global sugar industry, shaping market dynamics through policy shifts and the interplay between sugar and ethanol profitability. As we navigate through this year, it's clear that variations in the volume of sugarcane allocated for ethanol production will remain pivotal in determining market outcomes. The recent policy adjustments in India restricting the use of sugarcane juice and syrup for ethanol underscore the profound impact such changes can have. This decision, for instance, contributed to a substantial drop in global sugar prices as it eased concerns about tight supplies. Turning our attention to Brazil, the world's leading sugarcane ethanol producer, we observe that the government's ethanol blending mandate remains unchanged. Consequently, changes to the proportion of sugarcane directed towards ethanol will likely hinge on the relative prices of domestic ethanol and sugar. In Brazil, the domestic ethanol market is closely linked to gasoline prices. So when oil is expensive, ethanol becomes a more attractive alternative for consumers, especially given the widespread adoption of flex fuel vehicles. Presently, the domestic price of Brazilian ethanol suggests a reduced incentive for producers to prioritize ethanol over sugar compared to last year. With global sugar prices maintaining their strength and potentially poised for further gains, the economic signals favour an increased allocation of sugarcane for sugar production in the current year. Price equivalency analyses reveal that at this juncture, sugar has a notable advantage over domestic hydrous ethanol. It is crucial, however, to reckon this evaluation is rooted in current market conditions, which are subject to change. Should there be a significant shift in global energy prices due to unforeseen events, the demand for Brazilian ethanol could surge. This might tip the scales, making the diversion of sugarcane to ethanol production the more lucrative route. So according to the USDA's Foreign Agricultural Service, the allocation of sugarcane for sugar versus ethanol in the 2023-24 season was split at around 49% for sugar and 51% for ethanol. Yet given the existing market dynamics, we could anticipate a slight shift towards a greater allocation for sugar in the 24-25 season. As we consider the ethanol factor globally, it's imperative to account for other elements such as climate change concerns, the push for renewable energy sources, and evolving transportation trends. These will continue to influence the direction of both sugar and ethanol markets. Brazil's ability to toggle between sugar and ethanol production offers a unique buffer against market volatility, yet it also highlights the interconnectedness of global energy and food systems. Ultimately, industry stakeholders and analysts must remain vigilant, monitoring both policy changes and market signals to navigate the delicate balance between these two critical commodities. As we progress through the year, the decisions made by Brazilian sugarcane producers will not only reflect immediate economic realities, but also broader trends in energy consumption and sustainability efforts.
What will India's role be in the sugar market this year?
Okay, so India's presence in the sugar arena is crucial. Given its vast domestic production capabilities and considerable market size, making it an influential force in the global sugar landscape. Its impact on the market is shaped by internal production variables and policy directives. Reflecting on the previous year, India persevered through a sharp decline in production for the second successive year. Despite these setbacks, expectations peg India to contribute nearly 20% of the world's sugar output, solidifying its substantial role in the global market. Looking ahead, we anticipate India's sugar exports to be somewhat constrained. The central focus for the nation appears to be safeguarding its domestic market, where sugar prices have been surging due to complications in the harvest. Recent policy measures, specifically the curtailment of sugarcane juice and syrup for ethanol production, suggest that India's output will be sufficient to satisfy internal demand. Consequently, the likelihood of India ramping up its sugar imports remains minimal. While there was growing anticipation that India might need to increase imports due to looming supply concerns, the current forecasts indicate that such a scenario is becoming less probable. In sum, India's role in the sugar market this year is expected to remain significant, with its production influencing global supply dynamics. However, the country's export activities are predicted to be limited as domestic priorities take precedence, particularly in stabilizing local market prices amidst the challenges of domestic harvest. This strategic approach will likely keep India's import demand subdued, maintaining its traditional stance in the market despite earlier speculations of a potential shift.
Thanks much, Matthews. It's been a very vivid discussion, and you've come up with a very vivid description of how the market is going to be this year. So thank you very much for coming online for our business line State of Economy.
Thank you.
Thank you.